Thanks everyone for joining. I know we're at the top of the hour. We will make a start shortly. Still people dialing in though, so I just want to give everyone a chance to make the switch over from their last meeting. So like I said, we'll get started here in the next minute or so. Okay, those dialing in, just a reminder, we'll be starting here in the next probably 30 seconds or so. Just want to give everyone a chance to finish dialing in. Just give it a few more seconds here. All right. I think we're okay to make a start. About a minute and a half past the top of the hour. So anybody that's a bit slow joining, we have some introductions, so you'll have a chance to catch up. So I want to say first, thank you everyone for dialing in today. Hello and welcome to the ODCE analysis of the NCREIF ODCE Index results, the latest results to fourth quarter 2024. I'm Mike Amthor. I'm the head of the U.S. Performance and Valuation Analytics part of the business here at ODCE Group. If the accent sounds different this quarter from prior quarters, you're not imagining it. I'm here in place of Phil Tiley, who oversees our Global Performance Analytics Group and sits in London. I'm joined today by Alex Jaffe. He's a Senior Director in our Valuation Advisory practice. Hey, Alex. And over the next hour, we'll be taking you through the latest ODCE results of fourth quarter 2024. Now, this is an overview of the entirety of the NCREIF ODCE Index, so that's 25 funds. It'll be at unleveraged property level. And then within ODCE Group, we have an extensive valuation data set that we match up against the ODCE Index to provide some additional insights beyond just the return figures. This webinar serves to provide market insights to our wider client network and the industry, but it also serves as a basis for our upcoming one-to-one client conversations with those clients who do submit their data through to NCREIF, our NCREIF contributors, and have this analysis replicated on a portfolio and comparative basis. And we look forward to having those conversations over the next several weeks. Before passing it over to Alex, I just want to say thank you to everyone involved in getting things pulled together for this webinar. This is an extensive effort with many people involved, so thank you to everyone in our advisory group, other members of the performance team, the marketing team, our clients, of course, for privileged access to their data, as well as NCREIF for providing the index data. So we have a couple polling questions throughout, as we've done in prior webinars. But first, if we connect to the prior quarter, Alex, do you want to kick off with where we left off with the final poll from last quarter?
Sure, absolutely. So first, Mike, thanks for the opportunity to connect with you. Here we are showing the audience feedback from last quarter, or the crystal ball into what people anticipated was a 4Q unlevered property return. Majority anticipated the return to be 1% to 3%, or appreciation of 0 to positive 2%. I do like the optimism. We did have 1% who anticipated a strong gain. And then we had a few people who thought we were looking towards negative appreciation for the quarter. So Mike, it looks like the majority of the audience anticipated 0 to 2% appreciation. How did that end up, or how accurate was the forecast from last quarter?
Yeah, good question. So return in the most recent quarter, that total return came in at 0.7%. So that return fell just shy of the 1% mark on the low end of what the majority predicted. So I suppose results came in a bit more muted than what the majority expected in the most recent quarter. That said, the return was still positive 0.7%, and that's coming off of a positive return in the prior quarter as well. Last quarter, we reached that inflection point where returns turned positive for the first time after 2 years of negative returns. So that positive 0.7% return will still have some trade-off between income and appreciation. We'll certainly look into that as we dig into the details here. But again, second quarter of positive appreciation after 2 years of second quarter of positive total return, after 2 quarters of negative, 2 years, of negative total returns. those coming off of the back of that post-pandemic growth period. The last positive total return we saw was in third quarter of 2022, and that inflationary period or growth period came off the back of that initial pandemic pullback. So quite a bit of turbulence through the pandemic period. Most of that post-pandemic upswing that we saw through that late 21, early 2022 period has been wiped out by that recent period of correction, but returns now ticking into positive territory again and staying at a relatively steady positive in the most recent quarter. As a reminder, these total returns are on an unleveraged property level basis, so pure unleveraged real estate, no impacts from cash or fees, no impacts from property or fund level leverage or the mark to market of that leverage, purely real estate returns. So we take that total return and we add the first layer down and get into income and appreciation levels over that pandemic period. So first, I'll mention the components of the total return. So we've got income return in green, appreciation return in red. Mentioned that positive total return of plus 0.7% this quarter. We still have a negative appreciation return in fourth quarter 2024, minus 0.4%, but that income return plus 1.1% is pulling that total return into positive territory. Reminder with the income return, you do see some upward trend in income, but that'll be essentially income divided by capital value or asset value. So that positive trend, while income fundamentals have remained strong across most sectors, that negative appreciation has been reducing the capital base within the index. So that increasing income return is more a factor of a decreasing denominator effect. So that's the income return. If we look at the appreciation, where most of that volatility and movement lies, we've been breaking the pandemic period into 3 distinct movement periods. With that negative appreciation in the most recent quarter, it looks like we'll have to wait at least one more quarter before adding a fourth period. But to mention sort of the influences that we've seen since the start of the pandemic, we had that initial pandemic pullback. So we saw about 2.2% reduction to values through that first initial pandemic pullback, which was concentrated around second quarter 2020. Then we saw 7 consecutive quarters of positive appreciation, that post-pandemic growth period that saw about 24% added to values. But then much of that has been offset, as mentioned, in the more recent rising rate period, where we've now seen 10 consecutive quarters of value decline or negative appreciation, and that totals about 20.3% reduction to values within the ODCE index. And again, just speaking to these appreciation returns, I do want to remind this is purely unleveraged real estate, no impact of property or fund level leverage or any of the other components that build this from a property to a fund level return. So on the next slide, what we're able to do within Aldis Group with the extensive valuation data set that we have is we're able to layer in that valuation data and determine within that appreciation return how much of that value change is capital markets influenced, investor sentiment influenced, and then how much of that is down to changes in the underlying cash flow fundamentals. So what we do is we'll take the red bar and we'll transpose that onto the red line on the next page here. So now we're looking at just that appreciation return with those distinct periods and the influences behind that appreciation return. So just to orient everybody around the concepts on this slide, that appreciation return we break into yield and cash flow. Those are the components of value change. The yield impact, the yellow or orange bar, that will be value change due to changes in yield rates only. That's your pricing, your discount, and your exit cap rates. So that reflects essentially the investor sentiment or the capital markets influence on value. The blue bar then, the cash flow bar, that will be value change due to changes in the underlying cash flow projection, the cash flows that are being priced by those yield rates. So anything that's affecting whether it's leasing, growth assumptions, etc., anything on the cash flow side of things will fall under that blue bar. And so just to point out some key themes in that recent period of decline, that rising interest rate environment, we can see most of that negative influence to value has been on the yield impact side of things. As we've seen investment rates, discount and exit cap rates, see upward pressure in relation to continued upward pressure on that 10-year treasury. That impact, so that negative yield impact, has tapered over the past handful of quarters and continued to taper in the most recent quarter. Alex, it'll be good to get your thoughts on where rates are headed in just a second. But first, I'll mention then on the cash flow side of things, while we've seen value pressure due to yield impact over the recent down market, cash flows have been largely flat over that period. So we've seen about 8 quarters of minimal cash flow movement. And while it's not necessarily bad, the cash flows are generally holding up by and large. It's also not ideal given that cash flow upside has been a primary driver of value movement, upward value movement in values over the historical periods. And you can see that concentrated within that post-pandemic growth period, but then even pre-pandemic in that up market, we were seeing positive influences to value due to cash flow. So hopefully a return to upward trend in cash flow on the horizon as well. So while the yield impact is less negative this quarter, we've been trending toward less yield movement. That cash flow upside, while positive this quarter, has also taken a slight step back. So at the end of the day, you're left with value change effectively flat, values effectively flat, and a similar appreciation return to last quarter once you factor in the capital spend. So Alex, we're in this uncertain transition period where the election and inauguration have already happened, but the implementation of policy is still sort of unclear. Inflation, cost of capital, 10-year treasury, all of those remain elevated relative to our pre-pandemic levels. So where do you see yield rates and also fundamentals moving, specifically within commercial real estate, given all of that context?
Yep. So Mike, as you mentioned, there's certainly many unknowns, both positive and negative, but ultimately we are seeing transaction activity, underwriting activity similar or consistent with where the carry value or appraisal values are held. So we're not seeing much of a delta between when properties are held in a portfolio or when they're sold. We're not seeing big variances. And so I think that's part of the reason why on the chart, Mike, we are seeing a relatively flat cash flow effect, a relatively flat yield effect for the quarter, because the transactions are verifying or demonstrating that the current underwriting is consistent. The other thing that we've heard, and we think is a sign of a healthier market, is it's not just the one transaction or the winner of that transaction. We are hearing multiple bidders, multiple institutions around certainly certain sectors, certainly MSAs. And so that also feels like a healthier marketplace where it's not just one firm or one institution. So we're seeing a deeper bidder pool as well. As you mentioned, Mike, and we watch every day, the 10-year treasury has certainly been volatile over the past 3-6 months. But again, we haven't seen material change in the underwriting, in sort of the buy-sell decision. We've continued to see transactions occur despite some of the choppiness in the 10-year. So again, no real movement. The other thing, I know, Mike, you and I have spent a lot of time talking about, we've seen with some of our clients, is we also get the question, not simply just how is the current quarter or how is this rate correction period, but how does that compare to GFC? Or how is the data set for value change or value appreciation or negative appreciation relative to post GFC? So Mike, I know we've done some analytics on that. So could we move to the next slide and look into how we've sort of compared and contrasted the 2 time periods?
Yeah, certainly. Thanks, Alex. Using the Altus valuation data set, as Alex mentioned, we've layered in the valuation data against the return data, running that same yield and cash flow analysis for the GFC that we run for that rising rate period. We then indexed the first negative appreciation quarter in each of the 2 down cycles and charted the cumulative appreciation return as well as yield impact, cash flow impact, and capital impact. So a couple things to note: rising rate period up top, GFC down below. On the bottom, we did see more value decline through the GFC period. So that value decline, that negative appreciation, eclipsed minus 30% within the GFC, whereas we sit closer to about minus 20% in the rising interest rate period. But we did see more pronounced and earlier yield movements, yield impacts in the rising rate period. So the magnitude of that negative yield impact on a cumulative basis in the recent period outpaces the negative yield impact through the GFC on the same index. That said, the main difference that you can see is on the cash flow side of things. So through the GFC, where that 30% negative appreciation comes through, 15+% of that was on the cash flow side of things. So significant deterioration of cash flows through the GFC. Whereas through that rising rate period, we've actually seen positive influences from cash flow movements. Now, reminder, that's on an aggregate basis. That doesn't get into the interplay among various sectors. I'm sure many of you will be thinking through the various impacts there, but on a total basis, that difference in cash flow impact seems to be the primary difference in value movements between the rising interest rate period and the GFC.
And Mike, just to double click on the comments on the cash flow, maybe number one is we've seen on an aggregate basis rising cash flows in the rising rate period, which no surprise is primarily a function of industrial and apartment when we separate this by sector, versus GFC, every sector we saw negative declines in cash flow. So that's the real difference. We've also separated this and specifically looked at office. And I know Mike will touch on office much more in the presentation, but we've seen office behave very similar to what it behaved like in the GFC, in the sense that we saw negative pressure on yields and negative pressure on cash flows. So the interesting part about this rising rate period is the sectors have performed significantly different from a cash flow perspective. And that's why we don't think it's a fair comparison to say on aggregate, why is the appreciation the same or different? You really need to look at sector because there's big deviation that we saw this time versus what we did not see at the GFC. So Mike, maybe I'll pass back to you to walk further through the next set of slides.
Thanks, Alex. So we take a step back then, looking at total returns again. So this table has total return history on an overall basis and then by sector down below. Most recent quarter on the right-hand side, fourth quarter of 2024. That return, again, remains positive in the most recent quarter, coming off of 2 years of negative returns after that turned positive last quarter. Speak to the color coding. Color coding for the sectors is relative to the overall return. So any outperformers will be in green, any underperformers will be in red. So the main points to take away from this slide in the most recent quarter, returns are fairly similar to last quarter across the board, whether we're looking at an overall basis or the individual sectors. All but office remained positive in the most recent quarter. So apartment, industrial, retail, and other returns all positive on total return basis. Office then on the flip side is negative. But that said, given the consistency in returns across the sectors, the spread between the highest returning sector and the lowest returning sector, while it did take a step up in the most recent quarter, that spread remains much lower than what we saw through the primary movement periods of that rising interest rate period. So dispersion still down lower than what we saw during that negative appreciation period. So just to speak to each of those points, results are still generally similar across the sectors. Retail and other remain on top. They've flipped which one of the two leads this quarter, but both of them sitting roughly around that 2% mark within 20 or 30 basis points of the prior quarter's return. Take a step back, 1% down or so, and you run into apartment and industrial. Again, both still positive, also flipping the rank order of those two sectors, but sitting around that 1% mark in positive total return territory. But then you have office, again, by itself on the negative side of things, that minus 1.6% return. Again, while slightly more negative than what we saw last quarter, still within a smaller magnitude of negative total return band than what we saw through the turbulence of that rising interest rate period. So that combination results in that lower dispersion in the most recent quarter. And so on the next slide, if we chart these total returns and take a look at the results, you can see each of those factors play out here. So first, returns similar to last quarter. Everything is generally flattened out into fourth quarter 2024. Mentioned that slight backing off within office, but largely similar. Office, again, remains the only negative return. The rest of the sectors on that overall return all clustered in that roughly 1 to 2% range. And even factoring in office, the dispersion in the most recent quarter much less than what we saw through 23-24, that rate correction period, as well as when we saw the highs of industrial at the top end through that post-pandemic growth period, as well as the initial pandemic pullback within retail. So this chart shows the dispersion, also serves as a reminder of the sector variances that we've experienced through this last cycle. I mentioned office down at the bottom during the rising interest rate period, industrial at the top, and then retail, that initial pandemic pullback. But on the next slide, if we look at the impact of those return variances, as well as the weightings, to factoring in both the weights and the returns, to look at the contribution from each sector to the total return. So starting on the left-hand side, again, with that initial pandemic pullback, second quarter 2020, you can see that was largely traced to movements in retail. So retail values sort of the first to be hit during that initial pandemic pullback. Then we got into that rising, that post-pandemic growth period, the upside fueled by industrial in red, and then to a lesser degree, multifamily in blue. And then we get into the inflationary period that we find ourselves in now, where all sectors have seen some pullback on values, have contributed to some degree to the negative total returns. But you can see by and large, the office has been the bulk of that negative total return through the recent rising interest rate period. So as we get into positive total return territory, and hopefully soon into positive appreciation return territory, as the market starts to normalize, it'll be something to monitor to see what the contributions look like across the various property types. If we'll move into another period of a lead contributor, like we saw in that post-pandemic growth period, or if things will be more balanced, like what we saw during that pre-pandemic upcycle. So those are the impacts of the individual sector returns on the overall return. On the next slide, this is a slide that we've shown in the past, just looking at the allocation, the weights, toward the different sectors within the ODCE unleveraged property universe. So main things to note here are the increases in allocation to industrial and reductions to office. So pre-pandemic, if you look at fourth quarter 2019, office made up about 35% of the ODCE index, industrial close to 18%. Fast forward 5 years to fourth quarter 2024, and those have flipped. Industrial now sits at about 34% of the index, while office sits at just 18%. And we always get the question when we look at the shift in allocation within the ODCE index, the question is how much of that shift is down to transaction activity and how much of it's down to simply value change within those sectors. And we've run some rough analysis, and our numbers come out to about 3-to-1 value change to transaction activity. So much more of an influence, probably 3/4 of that influence coming from value increase on industrial, value decline on office, compared with just about 1/4 of that from transaction activity. And that's certainly true for what we've seen in office, not so much transaction activity, but certainly significant movements in values, as well as the industrial influence that we saw in 21 and 22. So those are the primary movements. A couple others just to call out. Other property type or other sector, that sat at about 2 to 3% of the index pre-pandemic. That's now moved up to over 8% of the index. So a lot of capital finding its way into other. Retail has also taken a step back to a large degree through 18, 19, and then through that initial pandemic pullback. And then just to touch on all the sectors, one that we haven't seen much movement in is apartment. So apartments stayed fairly steady in that 25 to roughly 28% allocation range throughout that full pandemic period. So those are the allocations. If we get then into the individual sector returns on the next slide. So again, looking at income and appreciation returns, but here broken out by sector rather than just as an aggregate. So starting with that initial pandemic pullback, we saw that concentrated in retail. So retail with more negative appreciation returns through that period. The rest fairly subdued in terms of magnitudes of movement. Then we moved into that post-pandemic growth period, which was again fueled by industrial, positive appreciation, and then to a lesser extent, multifamily, both retail and office fairly flat through that period. And then we move into that rising interest rate environment that we find ourselves in, where appreciation turned to negative for apartment, industrial, and retail, but then office also had that additional pressure of the fundamental shift in leasing, which increased the magnitude of that negative appreciation through that rising interest rate period. And just anecdotally speaking, within office, I can remember 2020, 2021, there was that expectation that everyone was going to be back in the office after the fall or after the spring. That turned to 21, 22, and a lot of that return to office optimism seemed to be getting pushed out just another 6 months or so. And then into 2022, 2023, we find ourselves in an environment with an unemployment rate at or near an all-time low. The optimism for return to office started to wane to some degree, given that that didn't gain early traction. And then there was a bit of a reality setting in that there would be a fundamental shift in office demand and office leasing, at the very least in the near term. And that's when we started to see that negative appreciation pick up within office late 2022. But again, focusing on the most recent quarter, just looking at those appreciation returns, positive in industrial and retail, apartment about flat, just negative. And then office, again, the only one with a negative appreciation. So as we did on an overall basis, we can take that appreciation return and break it into its component influences. So looking at the yield and cash flow by sector, first, again, sort of the shape of those appreciation returns. Initial pandemic pullback within retail was cash flow focused, that value decline. Then that post-pandemic growth period within industrial and apartment, that was also cash flow fueled. So significant upside, significant increase to cash flow fundamentals within industrial and apartment through that period. We also saw rate compression, so positive yield impact for those sectors, but that has largely been or entirely been unwound through the rate correction period, where you can see that negative yield impact coming through across all the sectors. Negative yield impact for all sectors, you can see to a larger degree than in office, given that office also had the challenges of that fundamental shift in the product and in leasing. So excess yield impact, negative yield impact for office, as well as additional negative cash flow impact. That said, you do see cash flows largely flat in the case of apartment, or even upside within industrial and retail through that recent 10-quarter rising interest rate environment. So as Alex mentioned, office the only one that really has been behaving similar to the GFC down cycle, whereas the other sectors have largely been holding off that negative cash flow influence. So just looking at the most recent quarter, where appreciation is largely flat, with the exception of office, yield impacts fairly minimal. A bit of compression within retail, so some yield upside on retail, but apartment and industrial fairly flat. And then you see a bit of cash flow upside within industrial and retail. But then when we look at office, you continue to see a negative influence coming through both on yield and cash flow. And the yield impact within office less negative, so maybe an indication that rates do continue to stabilize to some degree, but that cash flow impact, the magnitude of that negative impact has picked up just a bit in the most recent quarter. That said, the appreciation return sitting within a lower magnitude band, again, than what we saw through the teeth of that rate adjustment period. So by and large, returns similar to last quarter across the four main property types. And then just to round out our fifth main property type, that other property type, of which about 50% is self-storage. Appreciation, again, slightly positive for both other and self-storage. You can see that yields, again, have largely flattened out, so not much of a yield impact at all. Where there is positive influence, it's on the cash flow side of things. So cash flows remain on a positive trajectory in the most recent quarter for other and that large component self-storage. We take those appreciation influences from fourth quarter and stack those up, ordered from highest to lowest here. Again, you can see minimal yield impact, some positive for retail, some negative for office, but it's really the cash flow impact where that appreciation return starts to come through. So positive cash flow impact, other retail, industrial, and apartment, whereas office continues to see that dual negative influence from both yield and cash flow, resulting in negative appreciation. So if we first look at the rate movement trends on the next slide, so we have discount rate and exit cap rate. Again, these are those yield impacting measures. So just sort of taking us back through the pandemic period, we saw that initial pandemic pullback within retail after rates were generally trending upward. Then we saw the post-pandemic growth period. We saw compression within apartment and industrial. That was unwound through the recent rising rate period. Retail continued to float up. And then we sort of had that recognition within office that rates needed to be adjusted as well. So office rates certainly increased to a larger degree than the other sectors. Most recent quarter, again, things generally flattening out, certainly across apartment, industrial, retail. Office continued to tick up to some degree, but when we factor in office, the dispersion in rates, discount and exit rates, remains wider than what we saw pre-pandemic, and certainly the widest since we've seen since roughly pre-2015 when industrial rates tightened in with the rest of the sector. So, Alex, do you want to speak to the ongoing rate movements and what's affecting those in the immediate term?
Sure. So, again, I don't want to repeat, but similar, we continue to see transactions close to or within a tight range of transaction activity. So we are not seeing much in terms of material shifts to discount rates, terminal cap rates. We do get the comment frequently, if you look back to 2019, it looks like the range of investment rates, whether it's apartment, industrial, office, retail, is much tighter in 2019 than it is if you fast forward today to 24 or end of 24. That's true, but if you unwind, and again, just to emphasize, the sectors have been performing significantly different throughout this part of the cycle. As Mike, you mentioned, office has been significantly repriced. Part of that retail component is urban or high rise, which has followed similar trajectory to office. And so if you separate the retail into grocery anchored, internet resistant, or Amazon type resistant centers, those pricing metrics are actually very close to the discount rates and terminal rates applied to industrial. So that band of investment, or those yield and cap rates, are much tighter for apartment, industrial, and arguably essential retail. And so that's something that we think doesn't jump out of this chart, but if you peel back the different sectors, it does. The other comment I make, Mike, just thinking about this chart, is whether you look at peak pricing in 21 or whether you look at 2019, we've moved discount rates, terminal cap rates 50, 100, 150 basis points from their low points or from where we were pre-pandemic. And we would say that's a material shift. And so it's really, that change has happened. The pricing has been effectively factored in. What we're really seeing differences in performance, whether it's individual portfolios, whether it's by MSAs, whether it's by subsectors, it's really cash flow driven at this point. And the discussions we have with our clients is really more focusing on the cash flow forecast moving forward. Fundamentally, how are the assets operating? And it seems like there's less and less emphasis or less and less discussion strictly on the yields, strictly on the terminal cap rates, which as you showed in previous slides, Mike, we talked about yields and yield impact, for it seems like maybe 15 years, really 2 years, but it felt like 15 years being an appraiser. But now it seems like the conversation has shifted to cash flows. So with all that being said, Mike, let's move to the next slide in which we do dissect some of those cash flows further, which we're picking up more of the deltas on a go-forward basis.
Yeah, thanks for that, Alex. So completely agree. It seems like cash flows are really driving the appreciation returns at this point. So here we've stacked up those cash flows ordered by highest appreciation to lowest appreciation. Many of you will be familiar with the tack we take here, but for those who are not, we've shown value change, same store change of 6 key value impacting measures. So these are the 6 main cash flow impacting measures. These bars show the change in that measure. These are not impacts. They don't sum up to the cash flow effect, but they're designed to give a sense of what's being given a positive influence to the cash flow effect. That'll be anything in green, and what's had a negative impact on the cash flow effect. So here are the main themes to pick up here. Market rents, as well as contract rents, generally speaking, up across the board. So each sector is seeing some positive influence on both market and contract rents. Contract rent increase is more notable, particularly within industrial and other. Flip side of things, we've seen some increased vacancy within office, as well as to a lesser degree industrial and other, but a bit of a headwind on the cash flow side from the occupancy standpoint there. Moving across to rent growth rates, rent growth largely flat, the one exception there being other, but retail, industrial, apartment, and office ticking back a little bit, but those rent growth rates haven't moved a lot in the most recent quarter. And if we plot those down below, you can see that those have by and large reverted to the long-term mean pre-pandemic. So industrial and apartment saw some increase, some optimism through that post-pandemic growth period, but those have reverted largely to just above 3%. On the flip side of things, retail during that initial pandemic pullback saw that year one growth rate expectation drop near zero, but that has steadily ticked back up as optimism has returned to retail. So those three sectors back to around that 3% long-term average. Office then, again, sort of the black sheep here, where you see that market rent growth figure remains subdued. And again, that year one rent growth expectation within office sits close to 0%. So growth rate's largely flat. And then we factor in the expenses and capital. So expense ratio, which is expenses as a percent of revenue, continues to increase for office. And that capital expense ratio, capital as a percent of value, projected capital, continues to increase as well. So those remain primary headwinds to the office sector. And just plotting those, you can see that operating expense ratio remains elevated within office, and that capital cost ratio has really taken off over the past 10 or so quarters and continues to tick upward. So those are the primary cash flow influences. Just a couple quick charts to give an additional lens into some influences. So another chart that we've shown in the past, these charts show the percentage of valuations by count that were either an increase from the prior quarter in green, a decrease from the prior quarter in red, or value unchanged from the prior quarter in yellow. And you can see the separate influences through those distinct appreciation periods, but if we just focus on the most recent trends, we continue to see within apartment, industrial, and retail more green than red, indicating more write-ups than write-downs, which does speak to the positive appreciation, or in the case of apartment, just negative appreciation, but positive value change. But then in office, the number of write-downs, or the percentage of write-downs, continues to decline in the most recent quarter. That said, the magnitude of those write-downs does still tilt toward negative, given the negative appreciation within office in the most recent quarter. So based on everything that we've been through the past 5 years, the ups and downs, various sector growth and contraction periods, where do valuation levels sit now relative to pre-pandemic? So here we've charted cumulative appreciation for the 10-quarter period. That'll be the rising rate period in orange, and then the full 20 quarters of 5-year pandemic period in purple. So a couple points to note here. Over the 2-year period, or 10-quarter period, I should say, all sectors have seen a negative influence to value, so negative appreciation through that rising interest rate period. That said, that's been the bulk of office movement over the full pandemic period, most of office's appreciation coming over the past 10 quarters. On the flip side, that momentary setback in industrial, or really 10-quarter long setback in industrial, while it did pare values back to some degree, industrial appreciation remains still 50%, or still above 50%. So industrial values, generally speaking, 50% higher than they were at the start of the pandemic. And so with the purple bars, you can really see the trade-off in values that we've seen between office and industrial on the upside, and then the contraction within office, industrial gaining that through 2021 and 2022, and then the erosion of value in office through 23 and 24. So all of that shakes out to roughly minus 5.4% net negative appreciation through the pandemic period. Those are the main influences. Retail and other, a bit of a push and pull to a lesser degree, and then apartment, when you look at things over the full 5-year period, largely flat through the full pandemic period. So with that, Alex, after taking into account the past 5 years, can you give us a sense what we might expect to see in 2025 and beyond, coming off the most recent negative appreciation quarter?
Yep. So thanks, Mike. I'll keep my comments quick just to keep us on track for the rest of the webinar. But as we talked about, there's certainly some headwinds, right? Cost of capital is high. Inflation remains sticky. There's uncertainty about the new administration in the US. That being said, we have a lot of conversations with our clients around growth, limited new supply coming, this year, next year, over the next few years. There's potential for deregulation, which should be a positive to CRE and business. And then the other thing we haven't touched on today, but we hear, is the reverse denominator effect, in that given the increase in value we've seen in equities, a lot of portfolios are overweight equity and potentially underweight alternatives or CRE. And so that should be a positive factor if large firms are rebalancing that diversified portfolio back into CRE. So all that being said, we are seeing funds redeploy capital that we work with. We are seeing new vehicles launch. No new funds to Odyssey, but we're working with a number of existing clients or new funds, and so that's a positive signal. And we're seeing more capital come back in end of 24 and into 25. So our take is we think this will be a more positive year. We're seeing the growth happen. But we want to move to the poll question is, what does the audience think? And if that growth does occur, where do you anticipate that growth to happen? Will it be in the next 12 months in the apartment sector, in the industrial sector, in the office sector? We have listed retail, and then we listed other per Odyssey, and I know, Mike, you touched on it. About half of that is storage. Retail and storage were the highest performing sectors this past quarter. So Mike, if you had to guess where we think the appreciation or growth would be over the next 12 months, do you stick with retail or other, or do you think it will swing to one of the other property types over the next 12 months?
Yeah, that's tricky. I think I'd like to go with other. It's just tough to pick against industrial, given the continued upside in fundamentals that we've seen in industrial. So I think I might lean industrial, but others right up there.
Are we able to close the poll and see the results? So it looks like, Mike, you weren't alone. 22% thought industrial would be the highest performing sector. We also had a large share indicate apartment and retail, 6% office. So no one, it seems like, yet thinks there's going to be a major bounce, but we will see. But Mike, with that being said, let's jump into the individual sectors, and we can look at how they've performed sector by sector, and specifically some of the MSAs underlying.
Yep, thanks, Alex. So getting back into total returns, layering in a bit of geographic influence, and we'll move quickly through this slide so we can speak to the individual sectors. But many of you will be familiar with this, just to kind of orient you around these charts. This is our sector CBSA return grid, sometimes referred to as our Super Bowl squares chart. Particularly topical this week, and we're just a few days away from Super Bowl Sunday. Unfortunately, didn't get any Kelly Green in here, but I did want to add in Go Birds. That said, total returns by market. If you look up top, fourth quarter 2024, one quarter returns, a positive 80 basis point total return. Color coding is relative to the 80 basis points overall. So any outperformers in green, any underperformers in red. Same color coding for the middle table, and then the bottom shows the difference between fourth quarter and third quarter returns. So anything positive is an increase in returns. And main point to make on this page is that returns are largely similar when we look at things on a sector basis, although we do see some movement across individual CBSAs. So to get into the individual sectors, first looking at apartment. So to orient you around this chart, we've got the past 4 quarters quarterly returns up top for apartment, followed by 1-year, 2-year, and 5-year returns. Color coding here is relative to that period's overall return. So any outperformers again in green, underperformers for that period in red. So if we start down at the bottom with the 5-year, you can really see the trade-off between the more muted gateway markets, so Seattle, San Francisco, Los Angeles, Chicago, DC to some degree, and New York. All of those more subdued over that full 5-year period. And you contrast that against the growing Sunbelt markets, Inland Empire, San Diego, Phoenix, Denver, Dallas, Miami, and Atlanta, all of those doing better over that 5-year period. That said, that's been unwinding some in recent quarters with the likes of Chicago, DC, New York, and Boston showing strength in recent quarters, while some of the Sunbelt darlings, Phoenix, Denver, Miami, and Atlanta have stepped back a bit in recent quarters. And you can see that over the 1 year period, those influences sort of normalizing against what we saw during that post-pandemic growth period. And then over the 2 year period, that rising interest rate period, we've been picking up a bit of an east-west split. So more of the red numbers on the the left half of the chart, and more of the green numbers coming through on the right half of the chart. That's continued to some extent this quarter, although returns have generally normalized around that 1 to 1.5% mark. That said, there are a few outliers. Miami and Atlanta remain subdued, and then also some upside in Southern California there. So that said, that's total return. If we take a look at the appreciation influences in the latest quarter within apartment, so here comparing appreciation and then the yield and cash flow influences this quarter versus what we saw in third quarter 2024. So a couple themes. Yield impact has stepped up. So whereas last quarter it was sort of flat, not much movement, this quarter we've got flat with some tailwind, led by compression on rates in Inland Empire, Boston, and Seattle. So yield impact stepping up to some degree. On the flip side, cash flow impacts a bit less positive on the top side this quarter, and a bit more negative on the bottom side. So that cash flow impact has stepped back to some degree. So Alex, what do you make of these apartment trends, yield impacts moving sort of into positive territory and cash flow impacts sort of taking a step back in this quarter?
Yeah, so I think, Mike, you already touched on it. What's notable is the cash flow effect is much more muted in 4Q than it was in Q3. And we expect to see that carrying into first quarter. The reason is a lot of the 2025 budgets, some were factored in, some I know asset management teams were still going through those. And so ultimately, when those come into the first quarter appraisals, we are hearing higher insurance costs. I sit in California, so certainly higher insurance costs here, higher maintenance costs. So we continue to think there will be pressure sort of from an operating expense standpoint. Now the question remains, will the market rent offset those increases? It's early in sort of the spring leasing season, but I think the question is, potentially higher operating expenses on a go-forward basis. How much resiliency or how much can the market rent offset some of those cash flows going into Q1 and throughout 25?
Thanks, Alex. That's helpful. And just to pick into some of the details behind those cash flow influences within the apartment sector, you alluded to it, the market rents continue to move upward. So by and large, we're seeing market rents trending in a positive direction within apartment in the most recent quarter. Rent growth expectations largely unchanged. You see a bit of a pullback in a couple markets, but by and large, those rent growth expectations effectively flat. So we're continuing to see market rent increase. That said, to your point, Alex, we've still seen that year one operating expense ratio continue to edge upwards, which indicates that expenses are increasing at a slightly faster pace than rent increases in the most recent quarter. So that's apartment. Next, we'll walk through the same analysis for industrial. So again, past 4 quarters up top, 1 year, 2 year, 5 year down below. And so in the most recent quarter, we continue to see some of the same trends. Miami continues on its strong streak, leading the industrial sector. Southern California continues to face pressure, especially in Inland Empire, and then to a lesser degree within Los Angeles. If we look at things over the 5 year period, Southern California markets are still leading over that full pandemic period, owing to the upside during that post-pandemic growth period. But you can see over the past 2 years, the pressure that those have faced unwinding some of that upside. At the same time, over the 2 year period, Miami has come on quite strong. So continued positive influences within Miami industrial. Miami's now eclipsed all Southern California markets except for Inland Empire at this point. So Miami, the second strongest industrial market when we look at things over the full 5 year period. But over the 2 year, as Southern California has normalized to some degree, we've seen some pickup in some of those call them forgotten markets through that post-pandemic growth period. When you look at the middle of the country, the likes of Dallas, Houston, Chicago, Miami, all coming on strong over the past 1 to 2 years after lagging some during that post-pandemic growth period. So, Alex, what's going on in Southern California industrial?
Yeah, first, it's a good thing you moved out of Southern California, Mike. I think that's a good portfolio decision on your end. But we continue to see the rents come down in Southern California. Just to give you a sense, we had market rents for the assets at $1.50, $1.60, $1.70, some cases $1.80. And they've really come down to 120, 130, depending on where it's located, the age, the clear height, et cetera. So that's a meaningful pullback. You're talking 20, 30% decline in rents. And to give you a sense for the vacancy factor, that was 99, 100% leased in 21, 22. They've now seemed to have settled at around 92, 93% based on the peer set that we're looking at. But it's just the magnitude of that decline of the rents. We're talking 20, 30% on the face rates. It's taken some time for those to come off. And that's unfortunately what we're continuing to see, Mike, in Southern California.
Got it. Thanks, Alex. Appreciate that. If we look at the yield and cash flow influences across the various CBSAs, you can start to see that play out before we get into the specific cash flow valuation measure movements. But looking at yield and cash flow this quarter compared to last quarter, that yield impact, again, less negative than what we saw last quarter, similar to what we observed within apartments. So yields largely flat, even some compression then there, continued compression in Miami, leading to a positive yield impact in the most recent quarter. So yield impacts less negative, cash flow impacts then generally more positive at the top end, and then also less pullback down at the bottom end. So that cash flow impact improving in the most recent quarter as well. So in aggregate, less negative total yield impact for industrial, more positive cash flow impact, all of that resulting in more positive appreciation within industrial. And to pick into some of those cash flow movements in the most recent quarter, again, we saw up at the front, contract rent increases were a large driver of that. You can see contract rents up across the board within those industrial markets. The market rent also picking up nearly across the board. The exceptions tend to be on the West Coast, Southern California, Inland Empire, Los Angeles, as well as Seattle, also seeing a bit of a pullback in that face market rent. So rents continue to move upward. That rent growth expectation has largely remained flat. Some positive, some increases, some decreases, but by and large, market rent growth fairly stable in the most recent quarter. So, Alex, we talked about Southern California, but what are your thoughts on recent industrial trends with investment rates generally flattening out, fundamentals continuing to tick up for industrial as a whole, again, sort of ignoring the primary headwinds?
Yeah, so we've been surprised to the upside, and I think this chart does a great job of showing it. Markets like Dallas, South Florida, Atlanta, and we continue to be surprised based on what the underwritten rent is and then what the executed lease is. And we see this not just on existing properties, but assets that are under construction and that were pro forma at certain rents. We continue to see the leasing activity exceed pro forma levels. And part of that, and again, we talked about Inland Empire, Southern California at 92, 93% occupancy. Based on the peer set we have, we're tracking a market similar to Atlanta that went from 99, 100% occupied to now 95% occupied. So it hasn't had as far to come down, and it seems that it has stabilized 200, 300 basis points higher than some of the markets that you have, Mike, at the bottom of the chart. And that's really playing out in the market rent, either negative surprise or upside surprise, depending on the occupancy and fundamentals there. So Mike, can I pass back to you for office?
Yep, absolutely. Thanks for that. So similar analysis within office, touch on office to some degree. So first looking at it by geography, and you can see the gateways, those main central business district markets continue to be the most impacted. Seattle, San Francisco, Houston, Chicago, Washington, D.C., and New York among those. On the flip side, the Sun Belt has generally held up better, the likes of Dallas, Miami, and Atlanta, where there's been generally higher utilization of office space, but not a whole lot of movement in the most recent quarter. Those returns generally normalizing to more muted returns, with the exception of a few outliers that we see in Seattle, Denver, and Chicago specifically. But as with the other sectors, if we look at the cash flow influences behind the office sector compared to last quarter, yield impacts much less negative than last quarter. So we see more muted impacts due to increase in yields in the most recent quarter. And then on the cash flow side of things, If we ignore those three outliers, cash flow is largely, again, fairly muted in the most recent quarter relative to what we saw last quarter. That said, we'll acknowledge that there are those three outliers that are resulting in a more negative cash flow in the most recent quarter. So that's the quarter-to-quarter comparison. And if we look at the cash flow influences, we mentioned at the top, market rents generally up across the board for all sectors. You do see a bit of that influence within office, but that said, we do continue to see market rent growth continue to be pared back to some degree, and then also that capital cost ratio continues to tick up. So certainly headwinds offsetting any positive momentum that might be coming through from those face market rents on the cash flow side of things. To look at office through another lens, many of you would be familiar with this analysis we picked up the past handful of quarters. For those who aren't, or as a recap, we break the office market into similar operating office products to isolate various movements within that broader office umbrella. So first, we'll remove life science and medical office. Those will be in blue at the bottom. And then we separate general office into low, medium, and high risk buckets. So this quarter, we've switched the color coding for medical office and life science from green to blue to speak to those subtypes a bit more neutrally. With that said, within general office, the difference between low, medium, and high risk tends to be based around occupancy and lease term. Low risk will be assets that are well occupied with long remaining term. High risk then will be the flip side, low occupancy, shorter term, or assets in more challenged benchmark. Most of the index, or largest component of the index, sits in medium risk, roughly 40%, about 35% in high risk. Then you have about 10% low risk and 12 to 15 between medical office and life science. And you can see the 3-year appreciation returns or value change across those 5 different buckets off to the right. So life science, most resilient, along with medical office, followed by low risk, medium, and high risk. And life science and medical office values have been coming down in recent quarters, especially for vacant space. But those returns have been held up to a large degree by some leases signed by larger credit long-term tenants that were signed before capital dried up in that space and the market turned. And medium and high risk certainly seem to be the most subdued among the office. But Alex, what are some themes that you've seen across office as the rate of yield adjustments has declined in recent quarters?
Yeah, so really what we've seen, and not just this quarter, but over the past 2 years, 5 years, we've seen a transition from certain assets from low risk to, as you categorize it, like medium risk to high risk. So to give the audience a sense, pre-pandemic, we had approximately 200 office buildings that were listed as low risk. That's now been cut in half to about 100 assets in low risk. So we've seen this gradual transition or market transition for which buildings are leasing, which buildings are not. So that's one thing that we've noted that's been pretty material. I would say the second thing is we have seen leasing activity in those low risk office buildings that have maintained the remaining 100, and we've seen bid activity on those. Some advisors have been selling those assets, and we've seen 5, 10, 15 bids at or above appraised value in those low risk buildings that have maintained occupancy, continue to lease. Specifically in New York City, it seems like the leasing characteristics are coming back faster or stronger than we see in other markets. So Mike, I know we have to cover retail here rather quickly, but I'll pass back to you to round out office and then just touch on retail as well.
Yeah, thanks, Alex. Yeah, so just to quickly touch on office buckets, we do break that out then by geography. Just a couple quick points to make. 6 markets, high risk buckets have now eclipsed that 50% value decline. New York has gone past 60%, and Portland is pushing 70% value decline. So significant movement in some of the more challenged CBSA's risk buckets. And then most medium and high risk buckets, CBSA buckets, have found themselves with greater than 30% value decline. So just a couple takeaways from this slide. But as Alex mentioned, getting into retail, just to cover the main themes off of retail. So this quarter, cash flow impact positive across the board, across those main retail, or across those retail subtypes, whereas last quarter, generally positive, but a bit more muted. So cash flow impact has stepped up to some degree. Also some compression from regional malls and neighborhood centers, leading to some positive yield impact in the most recent quarter. So retail generally trending positive, Alex, what are some underlying themes or trends emerging within retail? It's been pretty steady.
Yeah, we continue to see, and as you show on the chart, we see positive cash flow effect in retail. I think part of that is a lot of the short-term or percent in lieu of rent leasing that we saw during COVID. Those are now turning into permanent leasing. So there is upside for the landlords and owners from those leases burning off and being moved to a more permanent basis. So overall, and as you said, Mike, we continue to see retail be one of the strongest performers this quarter, last quarter, and we expect that to continue on a go-forward basis. So maybe with that, I know we're at the top of the hour, but we do have one last poll question for anyone who has hung on. So if we can launch the last poll question. What does the audience think for the total unlevered property return in first quarter 25? As a quick reminder, Mike just walked us through last quarter, or fourth quarter, I should say. It was positive 70 basis points. Do we think it's going to be greater than 3%, so plus 300 basis points? Do we think appreciation will be 0 to 2% positive, gradual improvement? Or do we have some who think that the appreciation will be less than 0%, or we could head negative for first quarter 25? So if we could see the results quickly. Looks like most people might think it will be 1 to 3% return, or appreciation 0 to 2%, so gradual improvement into first quarter.
Yeah, I think that sounds fair. We're hoping we turn the corner on appreciation in the next quarter. So before we get into the main points, just want to make a quick note about our benchmark manager product. So breakdown of appreciation and yield and cash flow variances. It's one of the main requests that we receive after these webinars, asking if we can replicate this analysis for a client's own portfolio on how that compares against the benchmark. Within the performance analysis team, we're already doing this with the clients who pass their data through to NCREIF and then taking that to portfolio return. But for everyone else, we've been busy building out an analysis platform that enables any fund to compare themselves against the valuation trends across our wider valuation data set. That initiative is part of what we've termed our Argus Intelligence program. And this specific initiative is our benchmark manager product. And the idea is to enable clients to build up a narrative on portfolio movements compared to the benchmark, similar to what we've done through this webinar. If you're interested in receiving similar analysis on your portfolio or a consultation to explore those possibilities, drop us a note in the chat or please reach out to your account rep or Alex or me, and we can set up a demo as that product is expected to go live toward the end of first quarter. So that brings us back to our main themes, sort of overview. So again, positive total return in the most recent quarter. Appreciation does remain negative. Value's not moving, but that capital pulling it just in the negative territory. Yield rates, discount exit, continue to stabilize, but cash flow upside also has reduced in the most recent quarter. Appreciation largely positive or flat, with the exception being office, of course. Rent driven, when we look at both apartment and industrial, rent driven cash flow upside. Office continues to face some asset specific pressure, but most metros did see some normalization of returns in the most recent quarter. And then within retail and storage, we do continue to see further cash flow uplift led by rents, as well as some rate compression within retail. So now we're a bit over. Like that.
Yep. So Mike, we did get a few questions come in. The fact that we're over, we appreciate everyone who has stuck around for 3-4 minutes over. We will certainly get back to you on individuals who submitted questions, but we appreciate everyone meeting with us for the past 60 minutes, and we look forward to next quarter. And hopefully, as Mike said, we enter that positive appreciation territory. Thanks all.
Thanks everyone.
Bye.